Welcome to the deep dive. We're here to crack open the inner workings of companies you probably know well, but whose strategic plays might just surprise you.
That's right.
Today, we're diving deep into O'Reilly Automotive. I mean, a name that's basically synonymous with auto parts, right?
Absolutely. A cornerstone for, what, 68 years now?
Since 57.
Incredible. And our mission today, to go beyond just the headlines of their Q2 2025 earnings call and the press release.
Yeah, we want to pull out the really important nuggets, what's happening with their performance, their strategy.
And crucially, what it tells us about the wider consumer landscape, the
Yeah.
stuff that impacts all of us.
Exactly. And you might think, oh, earnings calls, just dry numbers. But honestly, when you dig into O'Reilly's story here,
Mm.
it's a pretty fascinating narrative. We've got sources that paint a vivid picture. How they're handling, well, everything from changing shopper habits to global trade stuff.
All while sticking to that professional parts people identity. Right. And you'll get some real insights, I think, into how a major retailer balances, aggressive growth with really dedicated customer service. It's a dynamic environment out there.
Okay, so let's jump right in. The headline numbers. Second quarter of 2025.
Let's do it.
O'Reilly reported a solid 4.1% increase in comparable store sales. And just a reminder that sales at stores open at least a year, so a good measure of underlying growth.
Yeah, Apple
That helped push total sales up 6%, hitting $4.53 billion.
Look at hefty number.
And the profits, they followed suit. An impressive 11% jump in diluted earnings per share, landing at $0.78 for the quarter.
And that diluted EPS, that's a key metric, right? Shows real profitability, even after accounting for all potential shares. Investors watch that one closely.
Definitely signals good financial health. But what's really fascinating, you mentioned the gross margin.
Oh, yeah. This really caught my eye. Their Q2 gross margin came in at 51.4%.
Okay.
Which wasn't just up 67 basis points. That's 0.67 percentage points from last year. It also really handily beat their own forecasts.
Wow. So better than they expected.
Much better. And this isn't just a number, right? It really highlights how O'Reilly's focus on, let's say, operational management and supply chain efficiency.
Things like inventory control, supplier negotiations.
Exactly. How that focus is directly boosting their profitability. It's a lesson for any retailer, frankly. Managing that supply chain can be a real competitive edge.
Especially now with inflation and everything.
For sure.
Because that's a significant beat on gross margin. What was really powering the top line then? Who's buying the parts?
Well, O'Reilly basically has two main engines driving growth. You've got the professional service providers, think your local mechanic shop.
Right.
And then you have the do-it-yourself customer, the DIYer.
Okay.
In Q2, the professional business was clearly the dominant driver. They saw comparable store sales growth over 7% in that segment.
7%. That's strong.
Very strong. And it was heavily fueled by continued growth in ticket counts. More mechanics coming in more often.
And why is that pro segment doing so well for them right now? What's the secret sauce there?
Well, there's share gains there. They're pretty robust. And it seems to be a testament to the relationships they've built.
Ah, the relationship side.
Yeah, focusing on service levels, making sure the inventory is there, basically becoming kind of indispensable for those pro mechanics.
Makes sense. Time is money for a mechanic. Need the right part, like now.
Exactly. And O'Reilly seems to be delivering on that promise consistently.
Okay, so what about the other side, the DIY customer?
On the DIY side, they saw growth, but it was low single-digit comparable sales growth.
Okay.
Now, the average ticket size was up. People were spending more per trip.
Right.
But they did see some pressure on the number of DIY tickets, especially towards the end of the quarter, in June. It actually resulted in a small dip in ticket counts for the whole quarter.
Interesting. So fewer DIY customers, but spending more when they do come in. What's driving that?
Well, the growth in average ticket size, that's happening on both sides, pro and DIY. And it's largely because, vehicle repairs are just getting more complex. Parts cost more.
Yeah, tell me about it.
And that dynamic, combined with the fact that consumers seem willing to prioritize fixing their current cars rather than buying new.
People holding onto cars longer.
Exactly. That actually reflects pretty favorable trends for the whole auto aftermarket industry, even if consumers are, generally being cautious elsewhere.
So necessities over wants.
Pretty much. You got to keep the car running.
And looking at specific product categories, what sold well?
Well, they saw strong performance in the essentials. Maintenance stuff like oil, filters, spark plugs. Makes sense.
Totally. Can't put off an oil change forever.
Right. And also solid sales in undercar or hard parts, especially for the pros.
Yeah.
But they did note continued softness in discretionary categories.
Like accessories or cosmetic stuff?
Yeah, things like that. Which, to be fair, they said is a pretty small part of their DIY business anyway.
Okay. But what does that softness signal?
To O'Reilly, it's a pretty clear signal from consumers. It indicates people are still being, cautious, conservative with how they manage their overall household budget in this environment.
Sinks what's broken, but maybe skip the fancy floor mats for now.
That's probably a good way to put it.
Okay, speaking of things hitting the household budget, tariffs. That was a key theme on their call, right?
Oh, yeah, definitely. The changing tariff environment. In Q2, they saw just under 1.5% contribution to their average ticket from what they call same SKU inflation.
So the price going up on the exact same part because of tariffs?
Right, reflecting those early stages of the tariff impacts hitting the system.
How are they managing that? Are they just passing it all straight through?
Well, their strategy seems to involve really close coordination with their suppliers, trying to mitigate the impact on the customer.
How so?
They mentioned negotiating cost increases that maybe don't reflect the full whack of the tariff hike, and in some cases, even delaying when those cost changes hit.
Ah, okay, so using their buying power.
Seems like it. And they did say the industry has historically been, quote, very rational in how it responds to these kinds of input cost changes.
Very rationally. That sounds, well, optimistic maybe, in today's volatile world. Could something disrupt that?
It's a fair point. I mean, while the tendency is rational pass-through, a really sudden shock or, prolonged uncertainty could definitely create some unevenness.
Right.
But O'Reilly's advantage here is likely their scale. Those deep supplier relationships, the sheer volume they buy, it gives them a bit of a buffer.
So they can absorb some initial shock better than smaller competitors.
Potentially, yeah. And manage a more controlled pass-through when it does happen.
Interestingly, they mentioned actually getting a timing benefit on gross margin in Q2 because of this. How did that work?
Yeah, that was a temporary thing. Basically, their price increases reflecting the tariffs went into effect slightly before the higher costs from their suppliers actually hit their books, their income statement.
Ah, okay. So a short-term advantage.
Exactly, like buying something just before the price officially goes up.
So looking ahead now, rest of the year, how do they see this tariff situation playing out? More benefits, more pressure.
They're actually not projecting significant further net benefit or pressure from tariffs for the back half.
Okay.
But they did say the environment is still fluid. They anticipate, and this was their phrase, tariff-induced choppiness in gross margin.
Choppiness. Okay.
Yeah, so potential short-term timing headwinds are possible, but ultimately they seem to believe these differences will, quote, even out over the long run.
Suggesting market forces will eventually normalize things.
That seems to be the expectation.
All right, so pulling this all together, what does it mean for you, the consumer? How does O'Reilly see the average person holding up?
Well, they view the consumer as relatively healthy, pointing to strong employment numbers, wage growth.
Okay, the macro picture looks decent.
Right. But they're still cautious about the potential impact of rapidly rising prices. They definitely acknowledge there's a risk of short-term negative reactions.
Especially from certain groups.
Yeah, particularly they mentioned lower-income DIY consumers who might just cut back wherever they possibly can if prices jump too fast.
Understandable.
But despite those concerns, their actual financial guidance, their forecast, doesn't really bake in a big net benefit from tariff inflation beyond what they've already seen.
So they're not banking on price hikes driving huge extra profits.
Doesn't seem like it. They sound pretty confident that any disruptions to consumer demand would be short-lived.
Why so confident?
They point to history. The resilience consumers in their industry have shown through lots of different economic cycles, whether it was past tariff rounds or, big spikes in gas prices.
People still had to fix their cars.
Fundamentally, yes. The basic drivers of demand are still solid. Cars are getting older, lasting longer, people still driving more miles each year.
That underlying need is powerful. But, is there a tipping point? Could inflation, maybe pushed higher by these tariffs, finally test that resilience? Is this time different?
It's always the question, isn't it? And I'm sure they monitor it obsessively. But the core nature of auto parts, so much of it is non-discretionary.
Right. If your alternator dies, you don't have much choice.
Exactly. You need to fix it. That creates a really strong baseline demand that just makes their industry more resilient than, say, selling designer clothes or fancy electronics.
So their focus is on staying competitive on price and service to keep people coming back even when wallets are tight.
That seems to be the playbook.
Okay, beyond just managing the current market, O'Reilly is clearly investing heavily for the future. Their SG&A costs.
Selling general and administrative expenses, yeah.
Right. Those costs per store grew 4.5% in Q2, which was actually above what was expected.
Mm.
And they said it reflects spending more to deliver great customer service, but also coping with inflation pressures themselves, like insurance costs.
All right, medical, casualty insurance programs, things like that add up.
For some companies, seeing SG&A tick up like that might be a warning sign. Why are they seemingly okay with it?
Well, they frame it very much as strategic investment, not just cost creep.
Ah, okay. Investing in growth.
Exactly. They see these initiatives, this spending, as directly linked to the market share gains they're capturing, especially with the professional customers.
So spend money to make money, basically. Better service leads to more business.
That's the idea. They're committed to managing SG&A, sure, but prioritizing that high standard of service to capitalize on growth opportunities. They even said they view challenging periods like this as chances to actually improve their competitive position.
Spend when others might be pulling back.
Potentially. That's a calculated bet. Invest now for loyalty and market share that pays off down the road.
And speaking of long-term vision, their physical expansion is, well, it's really something.
It's pretty aggressive, yeah.
First half of 2025 alone, 105 net new stores opened across 34 states, Puerto Rico, Mexico.
And they just hit their 100th store in Mexico in July, didn't they?
They did, a big milestone. And their full-year target is still aiming for 200 to 210 new stores.
That's serious growth. And underpinning all that store growth are some major investments in their distribution network. That's crucial.
Right, you can't run stores without the parts getting there efficiently.
Exactly. They announced they're acquiring a huge facility in Hazlet, Texas, near Fort Worth.
They're huge.
560,000 square feet. It's going to be their 33rd distribution center, or DC.
Wow.
Expected to serve around 350 stores in the south central U.S. And importantly, it'll free up much-needed capacity in the DCs around it.
When does that come online?
They're anticipating it'll be operational in 2027. These things take time.
And it's not just Texas, right? There's activity on the East Coast, too.
That's right. They're also nearing completion on their distribution center in Stafford, Virginia.
Oh, yeah.
And the plan is to start actually transferring stores to be serviced by that Stafford DC right at the end of Q3 this year. So very soon.
So these new giant warehouses, what's the strategic impact?
Well, according to them, these facilities will, quote, unlock store development opportunities,
Where specifically?
both in what they call the largely untapped Mid-Atlantic region, the Virginia and surrounding states, and also in their strong existing markets down in the south central U.S. where the Texas DC helps.
So it fuels even more store growth.
Precisely. They made a point of saying they currently hold just a fraction of the addressable market share in what's still a very fragmented industry.
Lots of independent shops and smaller chains still out there.
Tons. So these big capacity expansions are critical for their main growth strategy, which is basically gaining market share by offering better value and service to customers.
It really shows their belief that even in the digital age, physical presence and an efficient supply chain are still king in their business.
It certainly seems that way. Bricks and mortar plus logistics.
Okay, let's zoom out again. The big picture for the full year 2025. Did they update their guidance?
They did. They updated their full-year comparable store sales guidance, now expecting a range of 3.0% to 4.5% growth.
Okay, and total revenue?
Projected between $17.5 billion and $17.8 billion.
And earnings per share?
Diluted EPS guidance was updated to a range of $2.85 to $2.95.
And that's adjusted for that stock split they did, right?
Correct. They completed a 15-for-1 forward stock split back in June. So this EPS range reflects that.
And just quick reminder for folks, a stock split basically divides the shares up, makes the price per share lower, potentially boosts liquidity, but doesn't change the overall value of your holding.
Exactly. More slices, same pizza.
Okay. And beyond just growth and operations, what about returning value to shareholders?
Yeah, they're very active there too through their share repurchase program.
Buying back their own stock.
Right. In Q2 alone, they repurchased 6.8 million shares. Spent about $617 million doing it.
Bro. And long term.
Since that program started back in 2011, they've bought back a just massive 1.46 billion shares.
Billion with a B.
Billion with a B, for a total investment of $26.59 billion. They clearly see it as an effective way to return excess cash to investors and signal confidence in the company's value.
Okay, so we've covered a lot of ground here. Navigated O'Reilly's latest results, strong sales, these big strategic investments,
Right, their expansion plans.
their stance on the consumer, which is sort of cautiously optimistic, and this ongoing tariff situation.
Yeah, the choppiness.
It really seems clear they're playing the long game, doesn't it? Focusing on consistent service, strategic growth, even when the economy feels a bit turbulent.
Absolutely. I think what really stands out from this deep dive is just O'Reilly's unwavering belief in the resilience of the auto aftermarket.
Even when other consumer spending areas might be shaky.
Exactly, even when there are headwinds.
Yeah.
So as you think about all this, maybe consider how that balance plays out. The balance between immediate, non-discretionary needs, got to fix the car, and that general consumer caution around inflation we talked about.
How does that dynamic affect different industries?
Right. And what opportunities might pop up for companies that, like O'Reilly seems to be doing, really prioritize those strong customer relationships and invest heavily in strategic infrastructure.
It leaves you with a lot to chew on, doesn't it? About how these truly essential services adapt and, well, even thrive when maybe everyone else feels like they're hitting the brakes.
Definitely makes you think about resilience and strategy in a changing economic climate.